Okay, class, today we're going to be talking about budgets and financial records. It's very important that you have an understanding of budgets because, again, it's going to allow for you to be able to make smart decisions in regards to ways and how you spend your money. Now, the first thing that we want to do today is we want to talk about the different goals. Notice that the goals that we're going to focus on is preparing a financial plan along with a personal budget. And we're also going to explain the need for and also create a net worth statement and also a personal property inventory. At this time, what you want to do is you want to get a sheet of paper out, and I would title it budget because there's going to be certain things that I have you do during our presentation. Now, it's important that you understand that we do not have access to unlimited resources to buy all the things we want. So what a lot of people do is to create a budget in order to achieve financial success and also make sure that we have a plan and also documented piece of paper that we can have to see how much money we have coming in and also some of the expenses that we have to come out. Now, by creating a budget is going to allow for us also to have a clear roadmap that's going to take us to achieving financial security. So budgets are an important part of that. Now, it's important that we understand incomes. Now, as we know, we have our gross income, which is the amount of money that you make before deductions. And then we also have our disposable income. Now, when we talk about disposable income, this is the money that you have left to spend or save after you pay your taxes. In order to use this income to your advantage, you need to develop a financial plan. When we talk about the financial plan, it is a set of goals for spending, savings, and also investing the money that we receive. Now, there are 5 benefits to developing a financial plan. First, you can determine and evaluate the options for your money. You can then prioritize your options so that your money can go as far as possible. It also allows for you to avoid careless and also wasteful spending. You can also organize your financial resources, which are your sources of income, so that you can achieve your financial goals. And then also, it allows for you to avoid worrying about money by planning to save, planning to spend, and then also identify the need to borrow if you live outside of your income. Now, you want to also visualize your future. When we talk about visualizing your future, you want to think about what comes in and then also how it goes out. Now, one of the things that you will notice is that when you develop a budget, this will allow for you to analyze what comes in and then also to determine how the money goes out. Now, if you're noticing that a lot of money is going out to unnecessary things, then you can also think about changes that you need to make in order to make your money last longer. Now, let's talk about preparing the budget. Now, also, preparing the budget is the first step towards achieving your financial goals. When it comes to a budget is a spending and savings plan that's based on your expected income and also your expenses. When we develop a budget, we have a chance to take a look at the money that's coming in, which is our earnings plus borrowing, and it has to be equal to the money that's going out, which is going to be spending plus savings. Now, this is important because the budget has to balance, but again, it's going to help you to be able to plan your spending and also your savings so that you don't have to borrow money or use a credit card in order to meet your daily needs. Now, the next thing that we're going to do is we're going to talk about the steps in preparing a budget. Now, the first step that you want to do is you want to estimate your income. This is your total expected income for a certain period of time. Now, a lot of times we may develop a weekly budget, we may develop a bi-weekly budget, or a monthly budget. But again, you want to determine your income for a time. Now, the next thing that you want to do is you want to estimate your expenses. Now, the expenses are going to be the money that you will need for day-to-day purchases, for things like lunch or fees or personal care items or any other type of expense that you may encounter. You then want to decide how much to save. Now, a lot of times after you estimate your expenses, you will find out that you have money left over. You want to decide how much of that money you're going to save. And then you want to balance your budget. Now, when we talk about balancing your budget, if your expenses plus savings exceed your income, you want to make sure that you adjust your plan so they match. You also want to avoid spending more money than you make, and you also want to avoid using things like credit cards and things of that nature. Now, let's examine the budget for Evan Anderson. Notice that this budget is for the month of September. Notice that you have income, you have expenses, and savings. Notice that Evan generates a total income of $380. So, again, step one, you want to estimate your income. Now, next we'll take a look at his expenses, which include daily lunches, supplies, clothes, and entertainment, which gives him a total of $280. What you will notice is that in his expenses, he also estimated how much he was going to spend in regards to entertainment. Now, after he determined all of his expenses, it then left him with $100 to put in his savings. Now, notice that he uses a credit union account. Now, notice that now we have to balance the budget, so we want to make sure our total income is equal to total expenses plus savings. So notice that these two numbers match. Now, what I want you to do is I want you to think about your income, and I want you to develop either a weekly budget, a bi-weekly budget, or a monthly budget. You can also pause the video. Now, another thing that we also have to take into consideration is going to be fixed expenses versus variable expenses. When we talk about fixed expenses, these are costs that do not change from month to month. Now, a lot of times these costs are going to be costs that you're obligated to pay at specific times. For example, you may be obligated to pay your rent, your utility bills, a car loan, or insurance premium. These again are going to be fixed expenses. We also have our variable expenses. When we talk about variable expenses, these are costs that vary in the amount and the type depending on the choices you make. For example, if I choose to go to the grocery store this month and make a lot of groceries, then I'm going to have a larger variable expense of if I choose not to make groceries. So you also want to think about your fixed expenses versus variable expenses. Now, it's also important to keep good personal records. This is going to make budgeting and also long-range planning easier. What we're going to do at this time is we're going to take a look at different type of personal records that we want to make sure that we keep. There are 5 type of personal records that you want to make sure that you store in a good location. That includes income and expense records, net worth statement, your personal property inventory, tax records, and other miscellaneous documents. The first thing that we have is going to be our income and expense records. Now, when we talk about income and expense records, a lot of times this includes our W-2 statement from banks and also statement from investment companies. These will all be considered to be income records. Now, when it comes to your W-2, this is going to allow for you to see how much money you've made for the year, along with also how much taxes were taken out. Now, what you're going to notice is that when it's time to do your taxes, you want to make sure that you have this document, and it's also required in order for you to actually file your taxes. Now, statements from banks and also statement from investment companies are also going to allow for you to see all sources of income that were generated. Now, there are also other examples of income records. These will include receipts listings from charitable contributions, also medical bills, and any type of receipts that you have for work-related expenses. Now, a lot of times when you prepare your budget or your tax return, These receipts and also statements will serve as documentation or proof of different type of income and expenses that you have. So it's important that you keep those documents in a location where you can find them. Now, the next thing that we're going to do is we're going to talk about a net worth statement. Now, when it comes to the net worth statement, this shows a person's net worth that's based on his or her own assets and liabilities. Now, when we talk about assets, assets are going to be any item of value that you own, and liabilities are going to be either money or debits that you owe to others. Now, when you take your assets and you subtract your liabilities, this then gives you your net worth. Now, a lot of times when we talk about net worth, it's important for you to be able to identify what your net worth is. Now, also, if your assets are greater than your liabilities, you are said to be solvent or in a favorable financial position. If your liabilities are greater than your assets, meaning that you owe more than you own, then you're said to be insolvent or in a poor financial position. Now, a lot of times when you apply for things like loan or when you apply for things like credit, they're going to take a look and they're going to determine if you're solvent or if you're insolvent, and they're going to use that to make their decision. So it's important that you know what your net worth is. Now, the next thing that we're going to do is we're going to take a look at an example of a net worth statement. Notice that this is Mrs. Newkirk's net worth statement. Notice that the net worth statement first starts with her assets. Notice that her assets include a balance in her checking account, her balance in her savings account, the value of her car, and also her personal property value, bringing her total assets to be about $9,300. The next thing that we're going to do is we're going to take a look at the liabilities. Now, notice that she has a loan on her car in the amount of $1,800. She also has a loan from her parents for $100, bringing her total liabilities to be $1,900. In order to calculate her net worth, we take her assets and we subtract her liabilities, giving her a total net worth of $7,400. Now, in order to balance out, notice that the total liabilities and net worth equal to be $9,300, which must be the same as total assets. But again, this is how you determine your net worth. Now, we also have personal property inventory. Now, when we talk about personal property inventory, this is a list of valuable items that you own, along with their purchase prices and the approximate current values. Now, personal property will include anything of value inside your home, being clothing, furniture, appliances, electronic devices, and so on. Now, when we develop a personal property inventory, it's also useful in the event of fire or theft or property damage, but it will help you to list lost items and also determine the value in order for you to actually claim an insurance claim. Also, a lot of people would take photos of these items and attach the photo to the inventory so that they can have access to that, and also they can keep it in a safe place so it can be evidence in the event that the property is either damaged, lost, or stolen. If you take a look at Mrs. Newkirk's personal property inventory, notice that she has each item, the year the purchase was made, how much she paid for the item, and also the current value of the item. Now, again, she would also take pictures of these items, keep it in a safe location so that in the event that something happens, she has evidence and she also has proof. Now, it's also important that you keep a copy of your tax records. When it comes to your tax records, you want to make sure that you keep at least 3 years after you file your tax return. Tax records include the return itself, which is a copy of the signed form, your W-2s, and other receipts that verify income and expenses that you list on your return. Also, by keeping tax records, if you have to have an audit performed, then also you can make that process easier by having all of those documents in a good location. Now, what we're going to do at this time is on a sheet of paper, I want you to write, check your understanding, and I'm going to give you 3 questions that you're going to answer and turn in. The first question is, what is the first step in budgeting? What is the first step in budgeting? The second question is, how are fixed expenses different from variable expenses? And the third question is, why would you prepare a net worth statement? This concludes the first part of our presentation.